All right, everybody. Well, welcome to our first webinar of the year. I want to thank all of you guys for being here. This is going to be a little bit of a special. This is a two-part webinar series. I might actually make it even a three-part before tomorrow night's over. I'm thinking hard about that. But night one tonight is myself and Mike Wade. I'm going to be talking a little bit about 2019. And I also want to show you the strategy that I am heavily immersed in that we do every year, which is Dogs of the Dow. I want to show you kind of a twist on that. And then I'm going to turn it over to Mike, who's going to be talking about really Q1 earnings and trading in this environment we're in, the way he trades in this. So that is our plan for tonight. We'll be taking questions, obviously, throughout the evening. Also, sessions being recorded, and we'll get the recording to you as soon as possible following the live event. And then finally, I've got the disclaimer here on the screen. So
you got to get it up there, Tom.
Oh, I don't have the disclaimer on the screen. Thank you there, Jay. Have the disclaimer here on the screen. Do we have the disclaimer, Jay?
Locked and loaded now and in view. Thank you, sir.
All right. Oh, boy. How many times have I done that recently? Anyway, guys, thanks again for being here. Like I said, with the disclaimer, you now have it on the screen. You can pause this at any time to read it in its entirety. However, just a couple things I want to point out. Number one, stocks and options trading have large potential rewards, but also large potential risk. Also, myself, Jay, Mike, everyone associated with Tom's Trading Room and Optionetics. We're here as your educators. We're here to show you what it is we do, and also to let you know that you need a broker to trade stock and options with. You must meet certain requirements. Everything we're going to talk about tonight is in US dollars unless noted otherwise. So, 2019, this has been, the year last year, and we talked about this at our, every year we do an annual partners convention, where we bring the folks together that were with us the entire year, that went through everything. And we really it's a graduation piece. We did it on a cruise this year. We also discussed how 2018 went, which really 2018 went very well, with the exceptions of October and December. All right, those were the areas where we deviated from. We have not seen that kind of deviation. December was the worst December on record in terms of the stock market. And of course, December didn't go the way we expected it to. So as I look into January, and here we are now, and we're well into January. January, typically the first 2 weeks of January, are areas where people take money off the table. But because so much money was taken off the table in December, it made sense that money was coming back into the markets. Now, I believe for the time being, we actually have captured a low. In the last several days, we've seen the market moving higher. In fact, I believe Thursday we had that 700 and some odd point move to the downside. So here we are, Friday up, all right, Monday up, Tuesday up, 3 days up in a row. That bodes very well for this market having that blow-off move to the downside. I don't believe that that the volatility is gone by any circumstances. I think volatility is going to be around. We've gone into a November that started moving higher. December pulled back. We could see, I think, the next few months of a lot of up and down. All right, a lot of areas where we're seeing markets channel bound. So, there's a couple of ways that we approach 2019. You could trade the long term, because the long term is going to be, it's more of an investor, not a trader. You can be safer that way. As I'm looking out at, let me log in, and as I'm looking out at what the calendar shows for January, and let me just dial this back a little bit. We can all see it. You've got an area here where, like I said, there's, here's January 8th. Now we saw the Thursday last week was a down week. So we were up, down, up. All right. And then up, up. And here we are going into the 9th. The calendar for 10 years shows us that we really start to see green into January 14th. I think that trend will continue. And then we run into February, we start to get a little bit of a pullback. But I do think going into the next few months, into the first quarter, it's going to be a choppy quarter. All right, believe it's going to be a choppy quarter, and we want to trade either to very, very long side, or you could do, one of a couple things. A, look to long term. I'm going to talk about that next. B, you could look to trading both ways, delta neutral. We're going to talk about that this tonight too. Mike Wade's going to discuss that. C, you could trade contrarian style. All right. And tomorrow night, we're going to be discussing contrarian trading with both Ray Voss, who's one of my programmers here on Tom's Option Tools, looking at Darknet and what Darknet is setting up for looking like into 2019. And then also, we're going to be talking with Rob Roy tomorrow night as he goes through Elliott Wave and explains Elliott Wave. And so, yeah, we're excited. Rob Roy has been added to our roster. All right, he's part of the Tom's team, and we'll talk to Rob tomorrow. But for tonight, what I want to do is I want to start out just the first few minutes of the night. I want to talk about a strategy. Dogs of the Dow, and more importantly, the puppies, has been year in and year out, has just outpaced the Dow, the S&P, the NASDAQ, even a couple of mutual funds. And I want to show you that, but I want to show you a twist on how we look at dogs of the Dow. So for those of you who have never seen dogs of the Dow before, it's a very, very simple strategy. I like simple strategies. I think a lot of us as traders and investors have gotten away from simple strategies. This is one of the simplest investment strategies out there. You simply select the 10 Dow stocks of the 30 that have the highest dividend yield. All right. You invest an equal dollar amount in each of these 10 stocks, and then you just hold through the year and rinse and repeat. That's it. Now, what we do is something we call the puppies or the flying five, also called the small dogs. So after you grab those, the market closes at the end of the year, right? You take those 10 Dow stocks that have the highest dividends, and you select the 5 that are the cheapest. Again, you invest an equal dollar amount in each of those 5. You hold them for a year plus for long-term capital gains, or what we call the LT, long-term basis, and you repeat that next year. All right. So part of this and why it works is because, number one, the Dow is diversified. There are 30 stocks in the Dow that spread out over 9 sectors. Number two, you've got contrarian investing because sectors rotate, and you're automatically put into buying the low sectors because those are the stocks that have the higher dividends. All right. There's dividend investing in this if you use the stocks themselves. There's value investing in this because, again, decrease in price means an increase in the yield. And the Dow is adjusted periodically, which works well for this strategy as well. So as the economy changes or companies change, some companies are replaced by others. If you remember, Apple took the place not too long ago of AT&T. All right. So that's really kind of how it works. There's also a dividend equation on this. Now, this is if you own the stock. You get a dividend, and typically those are paid out quarterly, but that doesn't mean that there's special dividends that aren't paid as well. So a dividend is just simply a cash payment from the company's earnings. The way we come up with yield is we look at what the company pays out relative to its share price. There are 2 dates you need to think about if you're going to invest in the stocks in the strategy, and that's called ex-dividend date and then what's called dividend date or payable date. Ex-dividend date is typically 2 business days before the record date. That means if you purchase the stock on its X date or after, you don't get the dividend. You have to be before ex-dividend date. Now, dividend date or payable date is the actual day you receive the dividend payment. So how has this performed in the last year, 3 years, 5 years, 10 years? Well, since the year 2000, the dogs of the Dow has had a 8.6% average return since the year 2000. The small dogs, 10.4%. Compare that to the Dow Jones Industrial Average, 6.9, S&P 500, 6.2, Fidelity, 5.3, and Vanguard, 6.0. So just on its own, this strategy outpasses a lot of the big things that you and I see every day in the markets, although it doesn't get a lot of fanfare. And I think the reason why Dogs of the Dow doesn't get a lot of fanfare, for those of you that are asking, is simply because it's not something that the CNBCs of the world, the FBNs of the world really want to talk about because it's not exciting. It's boring. but boring works in the area or the business of trading. Now, as we move forward, we can take a look, and you can see here these three areas and the returns that they have, like I said, far exceed. But what about options? Is there a way we can juice these returns with options? Absolutely. All right. We can do a number of things. I just put 4 of them up there for you, 4 different strategies. So we can do a covered call. That allows us to still hold the stock. Right? It allows us to hold the stock, get the dividend, and also bring in some additional premium. However, you lose the upside move on the stock, depending on where you sell the call option. You could buy a long call, which is the fraction of the stock price. Now, you get the upside move. And if, for instance, if the small dogs have an average of a 10% return, then would that mean the long call option could double in value? Yes. All right. Bull call spreads, which is another way of going long the dogs of the Dow. You could further reduce your cost and your risk, and you could have a double chance of even better chance of double there on the long side. And a bull put might make good sense too if you want to use the premium side of the particular strategy. All right. So really at this point, people kind of ask me, well, what are we looking at today? All right. So here are the current dogs as of December 31st. Now, again, this is a 1-year strategy. So, yeah, it's the January 8th, and we're talking about it 8 days later. But you know what? It's okay, because this isn't like we're not using weekly options here, guys. We're using options that expire in January of 2020. So, yes, the market's moved up a few days since this strategy first came out, but there's still a lot more room for this. All right, a lot more room to run. So, as of December 31st, these are your dogs of the Dow: IBM, Exxon, Verizon, Chevron, Coca-Cola, JP Morgan, Procter & Gamble, Pfizer, Cisco Systems, and Merck. If you look over on in fact, I pulled these right out of our tools. We've actually redesigned a portion of Tom's option tools to now utilize not only the dividend yield, but the forward dividend yield into creating this dogs of the Dow piece for you. So the blue arrows, I put those in here because they represent the puppies, the 5 cheapest of the dogs. So you can see ExxonMobil, Verizon, all right, Coca-Cola, Pfizer, and Cisco Systems. And those are your puppies right now as we're looking at the puppies of the Dow. Now, what I want to do is I want to explore a couple of these using some case studies to show you how you would set these up. So let's look at ExxonMobil first. So I'm going to pop on over. I have not pre-done these, all right? I want to do them on the fly with you. So let's go to option chains. First, you know what? Let's actually go to a stock chart for a moment, all right? So let's take a look at XOM. So ExxonMobil, if you notice, the stock has actually had a bit of a run to the downside as we went into the month of December. See how I said worst month ever for December on record? Well, look what's happened in January. Since January, since actually Christmas Day, we kind of moved sideways in oil. Now we started moving higher, and so in Exxon as well. So Exxon is now hitting around $72, all right, roughly 72.04 is where it closed today. So if I were looking at this as a dog of the Dow pick or a puppy, right, what I want to do is A, obviously look at stock price. Where's the stock price? B, let's go look at an overlay. Let's put on there the options implied volatility that's greater than 90 days. Because if I'm going to trade options that are greater than 90 days, I want to see where the IV is. The IV has been as low. This is just in this 6 months. So it's been as low as the teens. It's been as high as the 30s. Right now it's 24. All right. Still expensive. It's not cheap by any means. All right. So knowing that, the covered call might make a great strategy. The bull call spread and the bull put spread might make a great strategy too. I don't know if the call options would make sense, but the only way to find out is to go look at the option chains. All right, so we're not using January 2019. We're going to use January 2020. The options expire on the January 17th. Let's update the risk graph, and let's take a look and see what we got. All right, so here's what we see with the call options. All right, The 72 halves are going to be very close. That's expensive. $5.73 for an at-the-money option. All right. Look at the 75s, $4.58. Look at the 77 halves. It's $3.63. It might be better for us to either buy the stock and bring that 7.5% option in. All right. What I mean by that is you're bringing in over 7% option premium to go along with that 5% dividend. So you're creating a 12% cushion on the stock. All right. Or what we could do is we could look at a simple bull call spread, buying the 72 halves, maybe selling the 77 halves. All right. We can do that for less than 5 points. Then we're in. There you go. $210. So you could take a $210 position on a $75 or $72.50 stock, all right, have a year for that move to happen, and you have a position that can make 138% return, and all the stock has to do is move to 77.5, right? If you feel like that's too far away, then maybe you might be more interested in buying something that is in the money. All right, so let's clear this out. You could look at perhaps the 65.70. All right, so you're already buying and selling in the money options. You're looking to be taken out. You're looking to, and for those of you that are concerned, oh my gosh, that option I sold that's in the money, am I going to get called? Am I going to get assigned on that? Well, if you do, you exercise a long call and you take a maximum profit. But here is a situation where you are profitable above 70, right? You have maximum profit. You're actually profitable. Your break even, take a look at the break even on this. The break even is $67.95, which is well below where we are right now. As long as we stay above $67.95, we break even over the course of the year. If we're above 70, we maximum profit. However, the maximum profit is a little less than 70%. You don't get the dividend because you don't get dividends unless you hold the stock. But you have a position where you're in the money. It's a quality position, right? The risk is a little bit more than the reward, but you have a high probability where you stand right now. This is one of those fire and forget trades. You fire it off and you put it in the bank because it's a 1-year option trade. All right. So that's one way we could look at this. We could, we looked at buying a call. It looks a bit expensive to me. We could look at the bull call spread. We could look at the in the money bull call spread. We could look at a covered call, right? Remember the covered call, you're bringing money in and you still get the dividend, but you got to pay that expensive price. You got to hold the stock to do that. Another thing we could do, this is the last thing I'm going to mention, is we could do a bull put spread. So a bull put spread, if I clear this out, means we'd be looking at buying a lower strike put, all right, and selling a higher strike put and taking a credit on the trade. So let's take a look and see what that looks like. So here's our spread. Now, notice we're bringing in the $202. What it would have cost us, or what we could have made on the upside on the bull call spread. So the bull call spread and the bull put spread have the exact same risk to reward characteristics. The only difference is you took the money in on the purchase instead of paying out. Therefore, instead of, you still have the same risk to reward. The only difference is you're holding the money now, not someone else. That's it. All right. So a couple of different ways that we could do the dogs in a Dow. Again, long-term strategy. I wanted to start off with that for the first few minutes of the session. And what I want to do now is let me just take a look and see if there are any questions. Do you see any questions out there, Jay, that bear being asked? This is a very easy strategy, so I don't expect there to be a whole lot.
No, it was pretty straightforward. Tanya was asking about getting the dividend if you have the options, and you answered that saying that they have to own the stock to collect the dividend. Perfect. So we're good.
Yeah, I was amazed at how many people on our cruise, because I didn't have time to teach this, really wanted to see this again. And so, again, like I said, guys, I left you off looking at these stocks. You can get this. This is very easy to get. You just go into our tools. And you can see this at any time. You're going to go to stocks, you're going to go to stock analysis, and you're going to go to dividends. Once you're inside dividends, if you take the stock list and you pull up DJ30, which all right, you're going to see that whole list, and you're just going to pick those top 10, and there they are. They're pretty much exactly like we showed them. All right. So, Mike Wade, come on down.
I am in the room.
Because we want to hear about earnings. We want to hear about what you see going on. And I'm yielding the majority of the webinar to you because yours is going to take just a little bit longer to understand, especially for our group. Now, Mike, you're here, maybe once or twice a year. So it's exciting to have you on for our 2019, our first webinar of the year. Welcome. Glad to have you. I'm going to pass the baton over to you right now. So let me find you. There's so many, we got just a boatload of people here tonight. So it's exciting to have everybody here, but let me go ahead and make you the presenter. There you go, Mike. And you should have the con, and you do. So all you need to do is put yourself into presentation mode and you're good to go. And of course, Mike, I need you to activate your microphone because it looks like it's not on right now.
Oh, yeah,
so
I had it muted. I'm back now. Yeah, thanks for making dogs of the Dow or puppies of the Dow sexy. I've seen you do this presentation many times, and there's beauty in its simplicity, and then you add options to the mix, and the return on investment that stock traders get is blown out of the water, literally, with simple option strategies. So it's always exciting. Thanks for sharing that with us all. And I'm I don't usually trade the dogs, or the puppies, but I feel like I'm going to do that tomorrow.
Hey, so man, with the kind of market we've had in the last quarter, it's really pushed volatility real high, and that's just I think one of the safer long-term strategies to use as we go into the new year.
Yeah, agreed. I like the in-the-money debit spreads, or you could do it with puts with a put credit spread. Just letting them sit there, pull in 69% as long as the stock doesn't really drop too much, and history says it's going to go up. So, just that example is a way to blow the doors off the returns that stock traders are getting, and it's really a great example of the power of options. So yeah, thanks a lot. It's good to be here, Tom. It's always a joy and a privilege, and I've been around the community since 2002, and I love doing this, and I love sharing, and I'm a trader, and I study, and I try new things, and it's a lot of fun. It's like the cleanest form of adult entertainment. I love it. It's just the funnest thing. And for those of you that know me, and a lot of you do on the call, when I started trading, I was all I did was I sold. Well, to be honest, I sold naked puts. This was before Optionetics, and since then I got into credit spreads. And I want to start by sort of laying the groundwork for why I got into the world of straddles, and kind of give you a bit of background and tell you about what I love about the way we're doing straddles now with the buttons that have been built. Our partners have access to these buttons. And it's really typified if you look at this market here. Since October 1st or so, the markets have really been in a bit of a free fall. There's been a lot of volatility. What you'll notice in a market that's correcting as this one is that the corrections are often met. Here's a really good example. Right around Christmas, we bottomed at 235 on the SPYs, which corresponds to 2,350 on the SPX. And we were met with this massive update in the markets. And if you're bearish and then this happens, then that hurts. That can sting. So volatility is good if you're on the right side of the move. So I've got to tell you that during this market, if I'd have been trading just credit spreads as I used to, I would have probably had a lot of stress and anxiety and sleepless nights. As your short credit spreads get in the money, it can be difficult to manage, and it can oftentimes lead to loss. And trading directionally even is the same thing. So volatility like this in this kind of market produces a lot of stress and reduces probability of being right. But now, with the way I trade, this is the ideal market for the strategy that I lean on mostly these days for the last 5 years, and that is the straddle. Now, straddles are typically boring. And as Tom said in his presentation, boring is oftentimes really good. So let me just give you an overview of what I'm going to cover in this next 45 minutes or so. But I want to talk to you about straddles and the way I'm doing them now. A lot of you might be have taken my class or been involved in the new way of straddling. And I'm going to show you the scanners, do a quick scan, show you how it works and the improvements to the scanners. I also want to give you some current case studies. Obviously, we are in the earnings period. It's the prime time. This is the end of year earnings that are coming out. And oftentimes there's more volatility, implied volatility and stock volatility in this type of market. We'll start seeing earnings happen in the next handful of weeks and continue into February. So this is really prime time for this strategy. Back in October of last year, we had our best years over the last 3 years when I've been publishing these trades. I'm going to give you some results and show you and give you some examples of the kind of trades that are coming up. So this is really an ideal market. This is the best time to be talking about straddles. I want to show you our performance, and then I'm going to leave you with something that we've really just begun to evaluate. We've got something called gamma scalping, which is really at this stage, from what we see so far, outperforming even the strategies that I'm about to share with you to start. So that's what we're up to. Ask questions. Jay's standing by. This is the Straddle Mastery Performance for 2018. This is 5 months of performance. And just to kind of give you a rough idea, with average trade size being around $1,800 or so, we've generated a profit of $43.57. 58% of our trades have been winners, and our average win to loss, or average gain to loss, is somewhere in the neighborhood of 2 to 1. Usually it balances out at around 2 to 1, 2.5 to 1. So we're on track. But this is what happened in October, and this is what I'm anticipating happening in the month of January, end of January, early February, and that is with this kind of volatility in the market, these straddles work really well around earnings. There's a lot of opportunities coming up. I'm going to share 4 of them with you that you can play with over the upcoming weeks. But just in the month of October, we made just under $3,000 on 11 trades. 62% of them were winners, and our average win to gain was in the neighborhood of 4 to 1. So that's what I'm anticipating with the prime time earnings season that's now rapidly approaching. So that's what I got, and I'm excited, and I want you to have some of it too. So the first thing I want to start with is how I got hooked on straddles. So, trading is about patterns, recognizing patterns, and patterns that repeat, ideally. And this pattern is, to me, one of the most reliable patterns that you can find. This is an implied volatility chart. This is an older one. It's on Green Mountain Coffee. These are all over the place. You just got to know where to find them. But look at this. So you can see these implied volatility rushes. These happen because there's earnings approaching. All right. So the reason that we see the implied volatility rise is because options become more valuable, and people are willing to spend more for them because they're expecting the stock to gap at the earnings announcement. So option traders come in, and they usually right before the earnings announcement, the day of even, they say, you know what, I'm expecting the stock to gap, so let me buy a short-term straddle and let me profit when the stock gaps. So that's the idea. And if the stock gaps, that's great. But the issue is that even if the stock gaps, if it doesn't gap enough, then you're going to be dealing with what's called implied volatility crush. All right, so I got to looking at this pattern, and I was like, well, how can I trade it? Well, here's what I thought of. Wouldn't it be cool if we could ride this red wave or surf the red wave? Let's get in at some point in time before the earnings announcement, and let's ride the wave and then hop off the wave before the earnings announcement and avoid IV crush. It's just like surfing. So the idea is to hop in and ride the wave and generate some profits. So the issue though is because we're using short-term options to maximize the amount of implied volatility rush, the red line. Notice the other colored lines here, the blue, black, and green lines, which represent further time frames out further in time, that they don't rush as much. So if you want to capture this IV rush and to take advantage of this pattern that repeats consistently, you got to figure out where to get in. Do I get in 1 day before, or do I get in 20 days before, or 5 or 7, 6, 8, 9? You know, we just don't know, and every stock is different. So I called Tom's developers, and we developed a system that historically scans up to 10 prior earnings season and detects historically what the best day is to get in. And in every case, we get out before the announcement. So that's the basis behind surfing the red wave. We get in at a particular time, the scanners tell us when, and we count on implied volatility rush, offsetting the increased time decay that comes along with, or higher theta that comes along with dealing with shorter term options. And listen to this. This might be crazy to you, but we oftentimes will place a 7-day, 5-day trade with options that expire within 7 days or even 5 days. So we get in and we ride them all the way to the end to expiration. And historically, we know that works. So we're happy to really maximize the IV rush by trading the very shortest term options. Oftentimes, those are weekly options. Yes, we're buying weekly options long. We're not only buying a call, we're buying a put. That sounds crazy, but it works. And it works well, as you'll see in a minute. So this is I'm going to talk about 3 different strategies for straddling. And to complete the point here, surfing the red wave. So what we're doing, just to summarize, is we're entering an optimal number of days before the earnings announcement. All right, the scanners will tell us what that day is. We're going to buy the shortest term at the money straddle that's possible. Oftentimes, these straddles expire the day after. And this is the important point. We're only interested in riding the red wave, so we get out before the earnings announcement and avoid any gapping issues or IV crush issues. The impact of that, as you can see here, this is an example of a trade. We placed the straddle and we held it for a handful of days. And normally what happens with the straddle risk graph is you'll see the theta lines, they're called, or these colored lines, every day start to dip into loss. So on the left side of this risk graph is loss. Typically, you'll see these lines move this way. Because of the scanners, because of the strategy, implied volatility actually pushes the colored lines into profit. Look here. Do you see anywhere on this red line that dips into loss? This is a risk-free trade on this particular day. In fact, it's a guaranteed profit trade. So that's the system. Let me show you an example of what I'm talking about. This is one of the trades that we did last year. This was during October, and this was a trade that I published in my publication. And Shake Shack. I was in the Atlanta Mall the other day, Jay. I know you like Shake Shack, and the line was too long for me to try them out, but I heard their food is really good, and I'm sure their shakes are too. But one of these days, I'll try it out. Yeah.
Mike, so I was in the Atlanta airport yesterday, and they have a Shake Shack in Terminal A around A23 gate, and I can confirm to you
that they're good. Yeah, I was there too, actually, a few weeks ago, and that's the one I saw. And I wanted to try it out, but I didn't have time, and the line was too long. But tomorrow I'll be there on my way to Africa, and I am going to stop by. So it's cool if you can place a trade on a company and then buy their food with the money you make on the trade. That's always a fun thing to do, right? So here's what we did. We entered a straddle on a short-term straddle that had 17 days of time in it, and the earnings was 16 days away. And let's remember, we're dealing with maximum theta decay. We're going to be in this trade for 16 days, exiting on the 1st of November. And when we exit, this 17-day trade will have 1 day of time in it. What? Yeah, we're gonna take an option all the way to expiration. We're gonna deal with maximum theta decay. In this case, it was negative 54, 16 days before exit. The Vega number is also very high. So what we're counting on is implied volatility pumping up Vega and offsetting theta. The scanners detect whether that's likely to happen or not. So this is when we got in. You can see the beautiful centered risk graph, very volatile stock. That's always a good thing. Because if the stock moves, that's icing on the cake. The cake is IV rushing and pushing colored lines into profit. The icing is the sweet part, is if the stock actually happens to move as well, we make even more money. All right, here's the implied volatility curve. You can see that the IVs already started to rush. This is the optimal time to enter. And then let me show you what happened on the exit date on 11/1. This was the trade. We're looking at a trade with $1,000 of profit. Now we started with the original risk on this trade was what is it? Just $1,800 or so. So we made on the original debit, we made 56% in 16 days. That's massive. And notice the debit has been reduced as well, because we want to delta neutralize. When the profits are there, we delta neutralize them to lock in. So this is the day of the exit, and you can see the stock moved around, and this is our theta line as of the day of exit. This is pushed way into profit for two reasons. The first of which, you can see the implied volatility that was down here just went off the charts and pumped these colored lines into profit, and the stock actually moved. This straddle was actually adjusted. And here's the thing. So the profits are great, but the best part of this strategy is because we're delta neutral, and because historically we can expect an implied IV rush, implied volatility rush. We call this what's that mattress phrase? Beauty rest strategy. You're just not going to get hurt. If the stock gaps, that's icing. If the stock stays the same, stays in the body of the straddle, that's fine too, because implied volatility is coming in. So I would have to say, the profits are good. They're not home runs. The profit is really good, and the risk on these things is mitigated to a very large degree. You're just not gonna lose much money with this strategy. I'd say the average loss on these red waves is somewhere in the 10 to 15% range, and the average profit somewhere in the 25-30% range. And we win about 60% of the time. All right, so this is a boring, slow, easy strategy. There's really not much to do except buy the straddle and then sell it. We get into adjustments in some of the advanced classes that I teach, and even without the adjustments, this thing is really very straightforward. So I'll pause for questions, because I'm going to change the course a little bit and talk about breakouts, because those are also good if you've got a scanner that can find them.
Hey, Mike. John is asking if both the long and the short positions increase with IV.
There are no short positions in the straddle. So we're buying a call and a put. You can see here we bought a 60.5 call and a 60.5 put. We spent $6.23. These are two long options. There are no short options in this strategy. And we don't want there to be, because we want IV, the benefits of IV rush. So we're buying a call and buying a put. That allows us to capture IV rush for both options, and it provides us the ability to profit in the event that the underlying stock moves. And believe me, given the market we're in, we can reasonably expect that any straddle you place, the underlying stock will likely move in the upcoming couple of months, given what's going on in the markets. The volatility of the markets means that there's icing to be had on these straddles, in addition to the IV rush.
Thank you. How important is open interest?
Open interest is important. You want 100 units of open interest for the most part. Sometimes we go about what's the word I want to say? We relax that rule. Really, the rule that's most important is that the slippage be within 10%. So open interest is not directly important. What is important is the amount of slippage. So don't pay more than 10%, and you're going to be fine. So that's the answer there. You know, at the end of the day, we're not really concerned with open interest. What we're really concerned with is slippage. And typically when open interest drops, slippage increases. But there are cases where, many cases where, and this happens all the time in this system, it's very common for there to be less than 10% slippage and have open interest in the lower numbers. So we're very diligent about that. We don't take trades unless the slippage is less than or equal to 10%, which is really at the end of the day what's important.
And
That's
if you want one
question.
more, there's a couple of people asking about how you're choosing your strike prices, and then if you want to address that, great, and you're good to go.
Yeah, how do I pick strike prices? I'll show you. I'm going to get into the scanner, excuse me, and I'll show you exactly how we do that. All right, just before I get into that, I want to talk about two other ways that we trade. And again, there's a scanner behind all of these. There's three basic ways we're trading straddles. And we also do the traditional straddle, which says get in 30 days before, buy a 60 to 90 day at the money straddle, and then exit after the earnings announcement. That's traditional. And there are some cases where a stock routinely gaps enough to offset theta volatility crush in the event the gap isn't big enough. And so our scanners will actually go out and find that. In fact, the scanners will fine tune this 30-day requirement and tell us exactly how many days it makes sense historically to enter the straddle. So it might be actually 20 days. I've seen breakout straddles where we get in 3 days before, and that's the optimal day. So 30 days was sort of a broad brush academic number to avoid IV buying expensive options. But this scanner itself actually will show us. Here's an example of a straddle, a breakout straddle we did, and you can see the IV rush during the move up, and the stock gapped, and we did really well on that breakout. So you want these. You know, there's particularly in this market, this spooky chicken little sky is falling market that we have. You know, these kinds of big events are all over the place, and if you happen to be in a straddle on one of them, there's really nice short-term profits to be had. So let me show you an example of one that we did back in October. This was on AT&T. Tom, you mentioned AT&T earlier. So this was a traditional breakout straddle, and we happened to get into this straddle 19 days before the earnings announcement. Why not 30 days and why 19 days, you might be asking? And the answer is the scanners told me that on AT&T specifically, it makes the most sense to maximize your return on investment and to make 100% probability, historical probability over the last 4 earnings periods that this thing will make some money. And so that's why we placed it. We placed a basic straddle. This thing expired in 77 days. We're going to be in the straddle for 20 days. We're going to hold it till after the earnings announcement or to the day of, which is 10/24. So we placed it. This was the day before earnings. And we actually delta neutralized this at one point. I'm not going to go into that now. That's a little, you know, it adds a layer of complexity, but it's definitely worth learning how to do. But we recentered the straddle at one point. The stock moved up, and we're looking at profit the day before. We had at that stage, we had a 43.5% profit on adjusted risk. So we delta neutralized it, reduced the risk with an effective rate of return on the new risk of 43.5%. And so that was the day before the earnings announcement. And then on the next day, make sure I have the right trade here, 12/21, that's a different one. Sorry, on the next day, 12/24, the stock actually gapped, and we ended up with an even bigger profit. So if you think breakouts don't work, you're probably wrong. They do work. And if you know how to find the exact entry date, they work really great. Look what happened here. The stock gapped down and our 43% profit increased to 57%. We made $873 on the adjusted risk, which is phenomenal. So in this market, I can tell you that stock movement is only going to help this strategy, which works well even if we don't get a lot of stock price movement. All right. Now there's one other one that's called Breakout with a Twist. I'm not going to show you an example of that. But essentially, Breakout with a Twist is the same as traditional. The only difference is we avoid IV crush and we get out before the earnings announcement. So it's the safest of the three. Well, I can't say it's safer than red waves, but it's a safer version of the traditional straddle. Except, and the reason is that we get out before the gap, and the scanner tells us what circumstances, which stocks it works on, and how many days to get in before the earnings announcement. So that's a pre-earnings exit. So that's another one that we do. All right, let's do some searching. Let me show you how I find these things, and I'm going to give you a couple. So I'm going to go into Tom's tools. These are the premium tools that our partners get access to, and we have quite a few of them here in Straddle Trapper. The optimal straddle button is the one that finds the red waves, and then we have the breakout straddle. I'm just going to do a quick optimal straddle scan for you and show you how this thing works. But let's go ahead and run this thing against the S&P 500. And what it's going to do is do two scans. It's going to do an initial pass at 7 days before the earnings announcement on every optional stock in the S&P 500. So I'll click the search button while I talk, and it's going to go out, and it's just going to do a first pass. If I get in 7 days before on all these stocks, how well does it work? And I'm going to show you exactly the kind of stats we get back that really help us in determining whether or not we want to take on any of these straddles. So again, these are the red wave straddles. All right, so we've come back, and then this is a 7-day pass. So I'm also going to, for those of you that have the scanner, I had it a while ago, it's actually been improved. So I want to highlight the improvements in this quick demo. And what comes back in the first pass is, you can see we've got Royal Caribbean, we've got our slippage. These are the options at the time of the scan. Those aren't the options that we'll probably use in the end. And it gives us the number of wins, the buy before date for 7 days before earnings, the actual exit date. It tells us when the next earnings date is, the winning percentage, the average IV rush over 7 days. Look at Royal Caribbean, 147% IV rush over 7 days. I want some of that. I want to get some of that. We've got the average return on investment over 4 earnings periods. So Royal Caribbean, what this is saying is, if you get into Royal Caribbean with a short-term straddle, 7 days before the earnings announcement, historically speaking, it averaged 46% return on investment over the 7-day period. I would say that's pretty darn good. That's almost 7% a day without the risk that traditional directional trading brings. That's again the best part of this strategy. You're just not going to lose very much. We also have a couple of indicators that are really valuable. We can determine whether or not, to what degree implied volatility outweighs theta decay. So a 27 means that 27% of this 46% average profit was contributed to by implied volatility kicking theta's butt, Vega kicking theta's butt. That tells us that the IV rush really offsets theta decay. The sort of the practical way to think about it is, if the stock doesn't move, then we can expect that kind of profit. Now, the system also tells us how much we made on stock movement, what percentage, what portion of the profit came from directional movement in the stock. So 19% of this 46% average return on investment came from stock price movement. This stuff here is invaluable. I can really get a feel for how these trades are making money. All right. So that's a broad brush of the scanning results. Now, this is only 7 days. There might be a better entry date for all of these. In fact, there probably is. So what I do next is I go up and I click this optimal button, and this optimal button will go out, and for each of the first 7 stocks in the list, it will go out and detect and look for 1 month of possible entries and tell us precisely which is the best day or the optimal day to enter to maximize your return on investment. Now look at this first one. Well, 118% historic return on investment over 19 days. Yeah, that's pretty darn good. This is on PSX, which is Phillips 66. Oil is very volatile right now, as you probably know. So this company, we can anticipate more volatility going forward. All right, so this is a great case study. Now, this is a nuance that that I just want to tell you. If you see an asterisk, that means that the entry date actually fell on a weekend or a holiday, and it takes the entry date back to the date that was the last Friday usually. So this one, skip the ones with the asterisk, take the next one. This is on PSX, and look at this one. This is the one that I would recommend. This is a 21-day trade. This is not a recommendation. This is the one I would pick. I would like you to paper trade this. And what you do very specifically is you get in on the 18th of January, and then tells you when to get out too. Get out on the 7th of February. This is end of market. And if history repeats itself, expect there to be a return on investment in the neighborhood of 118% over a 21-day period. Heck, I'll take half that over a 21-day period for a strategy, for a straddle that is just not going to lose me very much money. So that's the idea. That's how the scanners work. It works the same for breakouts and breakouts with a twist, I call them. And that is the big part of my trading world now. And this scanner is awesome. It is freaking awesome. It does all the back testing for you, gives you breakdowns with you know, some really important information about theta vega and delta effect and all of that good stuff. So PSX, here's the one. Put this on your radar screen. I would also give you the caveat, make sure you verify the earnings date before entry. And if they change it, if it's not confirmed 2/7 and they make it 2/8, then get in on the 19th. So adjust your entry date to 21 days before the confirmed earnings date once it's confirmed. It's really important that you do that on this strategy. All right, so that's some searching. Here's some case studies. These are a couple of other red waves that I really like, and I wanted to share these with you as well. You can see that both of these have returns in the neighborhood of 60 to 65%. First one is on Xilinx and the other is on Royal Caribbean. So I'd like to pay for some of my bar bill from the cruise last December, Tom. So I'm looking at Royal Caribbean. I'm excited about making my money back there. We've got our buy date, the same date on January the 15th. The exit date is on, this is weird. Both stocks have the same exit date, although the earnings dates are different, AMC and BMO. That's the plan, that's the trading plan. Buy straddle on the 15th, sell straddle on the 23rd, and you're done. I don't know how to make that any simpler. Simple is boring. It's also exciting if you're making money while you're sleeping very, very well at night. Last point here before I move on to the breakouts. Again, ensure that your slippage is less than 10% before entry. Also verify the earnings date before entry. If it changes, make sure you enter the appropriate number of days before the announcement and you'll be good. So play with these two. Here's a couple of breakouts, same story. These have much higher return on investment. And by the way, all of these have 100% winning percentage over 4 earnings periods. That's another thing I haven't highlighted, but I'll do it right now. All of these have historical win rates of 100%. History is our only guide in trading, and history tends to repeat. So that's the power behind the system. Entry dates shown there, January 30th on Mohawk, January 22nd on CBOE, and you got your exit dates. You'll get the recording. You may want to write those down quickly as I chat here, but those are really two good ones. Again, verify the earnings date before entry, and number two, ensure slippage is less than 10% before entry. And again, notice that this is I love this. I would much rather be in an 8-day breakout trade than a 30-day. This is revolutionary. Most people trade 30 days before the earnings announcement on breakout straddles to avoid buying expensive options. We're not doing that. We know historically that 8 days is the optimal day to enter this breakout. We know that 17 days is the optimal day to enter for this breakout on CBOE. So there you have it. There's a couple of belated Christmas presents for you. Now, something else we're working on, I'm just going to tease you a little bit. But if I was to show you this performance report, this was in Q3. This particular system generated $33,000, and what do we have? 47 trades over 3 months, generated $33,000. The average trade size was right around 2,500. We can get that trade. You can make that trade size smaller. That was the sample that one of our students did, and this system generated 72% winning trades. What? Yeah, it did. The average gain was about just under 4 times the size of the average loss. So let's just break this down. 72% wins. The average gain, the average profit, was just under 4 times the size of the average loss, and that happens 72% of the time. Would anybody be interested in learning more about this strategy? Maybe so. Let's take a look at Q2. You might not be interested yet, but how about Q2? We had the same, we had 28 trades in Q2, generated 50K on 28 trades, a 96% success rate, with the average gain being just 3.5 times the size of the average loss. So I'm going to ask a real question. Would anybody be interested in getting underneath the covers of this system? And Jay, I'm sure the answers are yes. So if you want to chime in.
Unanimously so.
Yeah, that's what I was thinking. I would be. So this is something that we're working on, and I just want to be really upfront about it. This was actually one of our partners actually dug in, and he's done 1 year of live testing of this system, and we are actually taking his rules and we're using them in a scanner. We're building a scanner. It's not done yet. We're tweaking it. We're refining it. And so the idea is to capture his rules, and we're doing a really good job. It's looking good. And gamma scalping is the system. It's really the process of adjusting deltas by delta neutralizing straddles. You can read the official definition, but it's really about reducing risk and increasing probability. And another way to say it is this is straddles with adjustments between earnings. So we're really excited about this thing. It's we anticipate having it done in the next couple of months, hopefully. May take a bit longer, may take less. But with this new system that is really outperforming the pre-earnings straddles that I spoke to you about, what we have now with the entire trilogy of strategies is the ability to straddle the market, straddle stocks the entire year. We're really excited. I just want to take this opportunity to give a shout out to Dick Davis, who was the one that did all the work. And we've been working alongside him. He's been doing the heavy lifting and the push-ups. And we're all, it looks as though we're all going to benefit from his profound effort to make this system work. So we're really excited. That's the next version of straddles. Stay tuned. Tom, that's what I got. Back over to you, brother.
Awesome. Jay, are there any questions at all that you need to push to Mike?
Well, I guess it's kind of pushed to both you guys. Like, how do we get our hands on these tools? How do we get our hands on, finding or having the tools do this stuff for us? So I
Okay,
think that's
well,
going to go towards what you're going to talk about here, right?
yeah. So I just want to spend the last few minutes of tonight. I want to remind you guys tomorrow we got a lot more to cover. I've got Ray Voss and Rob Roy coming on, and we're going to be doing contrarian-based strategies tomorrow. It's going to be just as much fun and just as much education. But guys, once a year, Mike Wade comes on and does something called Straddle Mastery. And we're going to be talking about Straddle Mastery in the coming weeks because he'll be doing his 6 to 6 week. I think it's a 6 week program we're going to be doing with Mike this year, where he goes through all of this in detail, where you understand the fundamentals, et cetera, and then you move forward. But we also have the buttons that are going to come with this as well. But the reason I'm holding off on that right now is that I want to show you something that we also do that's just a once a year program. That's our partner program, our 2019 partner program. So for the last few years, we've been doing this partner program where we bundle all of our guys together. And so give you an idea what I'm talking about. We've got courses that we're bundling together, which is Mike Wade, and that's going to be, we're actually increasing that to a 6 week program because he's going to do a bonus session with the gamma scalping piece. That's going to start at the end of this month. But we also have Devin Pearsall. And Devin comes on with credit spread mastery. He talks about how we actually do something called the layered credit spread. Rob Roy, who's joining us for the first time, we've actually gotten Rob to come on back and join us. He's going to be on tomorrow night. He's going to talk a little bit about Elliott Wave, but he's doing a program called Elliott Wave Mastery, which is going to start in May. Jeff Beamer is going to be joining us again this year with his 5 week calendar spread mastery program. Also, Joe Contes is with us with Collar Mastery. I do an 8 week class, which is my advanced class. I'm going to be doing that toward the end of the year. And this is what we call Systems Mastery. Our partner program is what we call this, is where we're bundling everything together. It includes all of our classes and includes a year of our complete trader. We also go through real-time indicators. We also have monthly conference calls with myself and any guests that I bring on, show you what it is that we see in the market, as well as some very special opportunities that we do for partners only. We are going to have 1 year of live market mentoring webinars. There are 200 of them total that happen during the markets with myself and my team. Also real-time modules. And I include my cell phone number on this one because I want you guys to realize you have access to me. Now, I won't give you personal investment advice. I'm not licensed to do that. However, if you need me to help you with a scan or help you with something that we've learned, that we've been learning throughout the year, that's what I'm there for. All right. So that's our program kind of in a nutshell. But I want to add on some special bonuses that we're doing just for 2019. So we are having our 3-day Oasis event. All right. This year it's going to be in Orlando, Florida. Now, what we're doing here is this is where myself and the entire team come into Orlando. And for December, we're going to do 3 days of hands-on training. All right. The looks like we are looking at the Friday, Saturday, and Sunday, which I believe is December. Am I right, Jay? 7th, 8th, and 9th? I'm trying to remember what those days actually were. But we've boiled down those days, and I'm just signing the confirmation on the resort we're doing this at. Also, what we're doing is I've got lots of giveaways. Everybody's walking away with something pretty cool, as we've done in every Oasis event. But I've got some really great giveaways that we're doing for all of our folks. Obviously, you got to be there in order to get these. Like I said,
Well, we lost your sound a bit there, Tom. It's the 6th, 7th, and 8th, though. That's Friday, Saturday, Sunday.
Some new, Friday, Saturday, Sunday. So new 2019 partner bonuses. These are things that we're doing in 2019. Obviously, Rob Roy is going to be doing Elliott Wave Mastery. The other piece that I want to make sure you realize is that we've asked Rob during this 5-week program that he offers real-time alerts. And that is any day he gets something that pops up, he's going to be alerting you to an Elliott Wave trade. All right, this is something that we've added into the program. Also, we are bringing back. We actually have been talking to the folks over at Profit Source. They have been working on something over the past year that I have been given some kind of preview knowledge to. It's called Profit Source Mobile. It's going to be something brand new. It's going to work on your smartphone. It's going to work on any iPad device, Android or Apple. So they're calling it Profit Source Mobile, I believe is what they're calling it, that or Integrated Investor Mobile. That's going to also include Rob Roy's Elliott Wave indicators. So that's going to be included in the partner program as well. This is going to, again, start around mid-2019. We're thinking it's going to be May, all right? We're also doing something called Partner Insider Deals. So I've got 3 insider deal opportunities that are going to be available to partners only. We have an alternative investment opportunity, all right? And these are things you can't get anywhere else, all right? This is some relationships that I have with these groups, and I am passing these straight on to you, all right? I don't get commissions. I don't get any kind of a monetary, I don't get paid for these things. I bring them to you as part of the program. Alternative investment, we've got an LCE tax investment opportunity. And then new for this year, which is really cool, is that we have this gold mine crypto-backed opportunity. I want to talk about that just for a moment more because we did get some conversation about what this actually was. So I'll share this with you, all right? It is I call it a golden opportunity to grab a coin, which is trading over $10 a share for much, much less. All right, so this coin has been out for almost a year. It is it's a token, all right, digital token in the gold industry. It's what's called a security token. What a security token is, and we believe this is where the future of cryptocurrency is going. Not anonymity, but to have something that's a secure token that's fully compliant. All right, this token actually pays a quarterly royalty. Right, so it's paying out a quarterly royalty. The royalties are expected to increase, and it currently trades over $10. What is the symbol? All right, well, I'm not telling you that yet. That's for our partners to know. All right, but let me tell you something else. We are going to have a block of coins that we are going to be able to allot to the partners. This is the deal that I've done with the CEO of this company for, get this, $1. There's a small amount that we're going to make available for $1. There's a small amount we're going to make available for $2. These are all going to go to our partners, right? So partners are going to get the $1 only, but if we run out of those, the next price is $2. This is trading over $10 right now. It's right out there on the Blockfolio exchange, and so we're really excited about this because part of the deal that I did with this group was to allow them to offer a block of coins at their ICO price. That's the initial coin offering that happened last year. So we'll get into that as we move forward with our partner program. I plan on bringing this to all of our partners within the next 30 days. You will get the details on this on our February monthly meeting. So I'm very excited about bringing this to all the partners. All right. The program that I'm talking about is, if you looked at the value of putting all these things together, the software, the webinars, the mastery series, everything together, comes out to our platinum package, which is everything, is regularly priced at $36,595. We're offering it for $11,552. That'll be in 2 payments split up of $57.76. This is everything. All right, it's all the mastery courses, all of our tool and partner benefits included, and includes obviously the 3-day Oasis event. The gold package is if you want to just come down to myself and Rob's mastery courses. All right, because Rob's the new guy on the block this year, so we wanted to offer that as well. That's $85.64. Right, which is 2 payments of $42.82, or the silver package, and that's just my 8-week mastery course. All the partner tools and benefits are included, and the 3-day Oasis event. That's $57.76, which is 2 payments of $28.88. Right, if you're interested in that, what you'll do is, let me just do this. I'm actually going to take a cut of this. I'm going to put it right in the chat box so you can follow along with me. So if you take this link that I'm giving you, all right, I put it there. Let me put it in one of the Q&A pieces as well so that there's no problem at all with you finding these. So let me push this to everybody. Now you have that link. So if you click on that link, that'll take you to the page that you see right here, the partner program page. So you can see all of the information that I just shared with you. All right. Down at the bottom, you've got any of number of these 3 packages to pick. If you like one of these and you want to pick it, just click on it. That will take you to our terms of service. Read through this. Once you are agree to that, click on I agree. Going to take you to our PayPal page. The PayPal page, based on the program you have, already has the discounted value in it. It also has how we have the payments set up. You'll make one payment today. You'll make your next payment in 2 months. So we spaced them out 30 days apart. All right. If you have a PayPal account, it's easy. You just log in and go from there. If you don't have a PayPal account, it's even just as easy, because down here below the login page, you'll see no PayPal account, pay using your credit or debit card. You click here, follow the instructions, and it's that simple. Once you log in and pay for the program, you'll immediately get a confirmation from me, which basically says you're in. And then next week, we're going to release the dates for the first program we have with Mike Wade, as well as my first insider monthly partner webinar that we have scheduled as well. So fantastic value. I wanted to show you this. We only do it once a year. I'm going to tell you guys, I only have 20 spots. All right. We had so many people that were in our 2018 program renew and already be in for our 2019 program. They took up most of our spots. I got 20 spots left, and then we're filled up. So once we get down to those 20 spots, that's it. All right. Then we don't. This goes away for the rest of this year. In fact, this very well may be the last partner program that I do. All right. I've been doing these every year for the last 15, 16, 17, 18, 4 years now. This will be my 5th partner program. We made it the best one yet, but it very well may be the last one that I do. So if you're interested in combining everything together and, taking advantage of what we offer to, as a bulk of everything that we have, this is the way to get it. All right. Jay, any questions before I finish up for the night?
The question is open until how long? How long do they have to take advantage of this?
Sunday until midnight, or unless the 20 spots fill up, whichever one happens. You'll know when it fills up because you'll see a big red sold out tag on it. And then we may have a wait list at that point in case somebody fails to come through for one reason or another. Then we may have a seat or so open, but that's it. These do fill up pretty fast. I hate that we only have 20 of them available, but that's just the nature of the beast here. We keep this group to a small group. That way everybody gets the individualized attention that they need. It's a fantastic price, guys. I mean, we really have it 65% off that regular value there. So it's, we only do it for a certain amount of people. Once it's done, it's done. Like I said, we will be offering mastery courses throughout the year as one-offs, but bundling it together like this is really the best way that you can get the entire package of everything that we offer through 2019. All right, so thanks, everybody. Session is recorded. I'll get the recording out to you as soon as possible. And, of course, join us again tomorrow night. We welcome back Rob Roy. Some of you haven't heard from Rob in years, so I'm excited to bring Rob back. We'll see what he's been doing, and he's going to be talking about Elliott Wave, and he's actually going to be showing us, he's going to brag because we had him on last month with our partners. And he was already talking about December, that he expected new lows in the month of December. And then I had to bring him back at the end of the month so that he could brag about this. But he also told us where the markets were likely to go in January. So we get to see Rob again. We get to hear Rob talk about December. We get to hear Rob talk about the first week or so in January. But you know what? We get to see what Rob has coming up next in terms of contrarian trading. Also, Ray Voss is going to be joining us. He's going to be talking about Darknet and the very first app that we've ever created and invented, and partners are getting access to that when they sign up. The Darknet app is now available on iPhone and on the Android device, but right now it's only available for partners. He'll be showing you that live tomorrow as well. So join us again, 8 p.m. Eastern time. Till then, have a great night, guys. Recording coming out soon. I'll see you tomorrow night. Bye now.